Now, it looks like yet another Canadian miner may be taken off the board. Yamana Gold struck a deal earlier this year to be bought by the global gold producer Gold Fields. That deal valued at almost $7 billion US. The plan is to finish the transaction in Q3. We are joined now by the executive chairman of Yamana Gold, Peter Marrone. Peter, thanks very much for joining us.
Thank you, Andy. Happy to be here.
So, Peter, give us an update here, because I was just looking at your stock in New York, AUY, trading at around $5 US. Now, back of the envelope, Gold Fields is offering 0.6 of one of their shares. So my calculation is that would be about $5.60. So it looks like your stock is still trading below the on-paper value of the offer from Gold Fields.
Well, I think the important part, Andy, is that we haven't even published an information circular yet, both companies. That's pending and expected in the middle of September. I wouldn't presume to speak for shareholders. They are, after all, the ones who are enfranchised to vote for deals. But our information shows that shareholders are being thorough. They're taking governance seriously. They're listening to us on the value proposition, and they're being supportive. They would like to see that information circular. And in the end, my view is that by the time the information circular comes out, that gap that you just described will close and demonstrate that there's strong support. The transaction and value proposition are compelling. And I'm encouraged with the support and strongly believe that shareholders will vote in favor.
Right. It may be. What I'm wondering is, Gold Fields investors were apparently critical here. Some of them wanted more cash returns. And I mean, good for you. You got a premium of 34% in the deal. I know the Gold Fields CEO Chris Griffith says criticism is softening. Is that the kind of roadblock here, concern among the Gold Fields shareholders?
Well, it's normal when there's a premium that there would be some criticism, and it's normal that that criticism goes toward what's the value proposition and is a company paying a fair price. The premium is really a normalization of the comparative values. It's no more than what analysts are forecasting as the short-term target price for our company. The real value, Andy, is significantly in excess of that, in excess of what's been offered. And will flow to the benefit of both groups of shareholders. And as we communicate that, both myself and Chris, it becomes very clear to shareholders that this is a deal that they can support.
And when is your vote, Peter? Have you set a vote for your shareholders? The date?
So both companies are aiming for an information circular with the full detail on how we engaged in our transaction, the extensive amount of diligence that was done, and the value proposition. We do intend to talk a little bit about that value proposition in the form of a valuation of our company to demonstrate that that premium is just a normalization and there's a lot more value in our company. That is expected by the middle of September, and the shareholder vote then would occur sometime in the middle of October.
I was looking, I mean, scorecards like this are always, you have to be wary because when you go over a few years, but certainly over 5 years, Yamana looking good versus the TSX Gold Index.
We've performed well, but in part, the reason for that is because we've demonstrated that we have high quality assets. And even though we've had that strong performance, it was also clear to Gold Fields, as after many, many months, more than half a year of diligence, it was also very clear to them that there was a lot more value that was not being captured in our share price. And that's what got us to the point that we're at today.
Right. Maybe we can put up that 5-year comp chart in a second, although it does look like Yamana, you lag the gold index over 10 years. And I know you have to be careful when you're looking back over 10 years. A lot happens, companies come and go. Was that because there were concerns about your debt for a while?
For a period of time, that was the case. We cleaned that up, as you are aware. By about 2019, that had become a thing of the past, and we've been focusing since then, on that impressive portfolio that we have, the 5 producing mines, but with the other assets that includes expansions of existing mines, optimizations, and 1 new mine in our Wasamac project in northern Quebec that will get us initially to a production platform that is a full 50% higher production than what we currently have of roughly 1 million ounces of production going to 1.5. But Andy, may I say that there's a further point that is important here, because all of this growth that I've just described is coming at lower cost than our average costs. And that means that while the production growth is 50%, the cash flow growth is actually in excess of that.
That's interesting. Just can you give me say in a few years, I forget what time scale you gave me, can you give me an idea what your all-in cost will be, Peter, even ballpark, of per ounce producers? Go ahead.
Yeah, so all things being equal, because there's always some escalation of costs, and one thing or another can occur in any business. But presently, if we look at our second quarter, Andy, we produced every ounce of gold at an all-in sustaining cost. So that includes sustaining capital, G&A, and exploration expenses, along with operating costs of $1,084 per ounce. We've guided to be below $1,090 per ounce for the year. So even with inflationary pressures, that number we've been able to manage it very effectively. If we look at our Wasamac mine, Wasamac will be coming in at about $850 per ounce. That's below our average. The Canadian Malartic Underground will be coming in at about that same all-in sustaining costs, again, below the current average and below what Canadian Malartic is currently doing. And Jacobina is already a low-cost producer of below $770, $780 all-in sustaining costs. It's one of the lowest all-in sustaining costs in our industry. But with the expansions that we're planning, the unit costs actually come down even more than what I've just described. So overall then, I would expect that our all-in sustaining costs would be well below that $1,090 per ounce.
Peter, what happens to you now? I think I might have asked you this before, but where are you going? You're not sticking around with the merged company, I'm guessing. What are you going to do? Find a small startup mine, an exploration company, or are you going to take it easy for a bit?
Well, my objective and my singular focus at this juncture is to demonstrate to shareholders that value proposition. That takes us to the end of October and the completion of this deal. I haven't fully considered what would be my plan going forward, but I think that this is an industry where there are lots of toys in the sandbox, in the toy box. Some of them have been overlooked and should not be. Not dissimilar to some of the assets that we acquired in Yamana, and then demonstrated some impressive value. Remember, Andy, that our Jacobina mine was producing below 80,000 ounces per year, going back to 2014, 2015. And now we're at a run rate of 230,000 ounces and taking that to in excess of 300,000 ounces with that low cost that I described a few moments ago. And I think there are many other opportunities like that that we'll take a look at once this deal completes.